let's go to our real materials that I prepared for today. No fancy PowerPoint. This is just the financial statement, but I want you to understand from here how to treat the loan and the loan differently. PPP loan is forgivable. EIDL is not. So in this example, I am a restaurant owner, and for one period of time, I will make sales, and I have my purchase, and I have my other expenses. So I ended up with a 52,400 net profit for this period. This is the period where I did not use my PPP and the EIDL loan yet. I just got it. And I got it in this period because I'm suffering from COVID-19 effect. And so I applied for PPP, I got it. I got 30,000. Then I applied EIDL loan for my working capital, I got it. And however, they give me 150,000, and on the paper it says 150, but I got 149,900. So that is kind of my status. And you know, I have sales. My sales was much bigger before COVID. I have a cost of goods sold. Then I have all these expenses. I made some money, but I used to make a lot more. So I do get impacted by COVID. And so I qualify for these assistance. Now I want to know how to do accounting. Now, let's go to our balance sheet. I know balance sheet is really a big term, and the people who are not professional accountant, why do you have to know what is balance sheet? That's really kind of crazy. But I want you to kind of tune off the scaredness of just thinking of balance sheet and think of something. And in a very, very simple example, balance sheet representing how well doing you are, not by one period of time, but by the moment of time from all the past histories. So let's say if income statement is for the period of time, whether you made money this month, whether you made money this year, but balance sheet is not about this year. Balance sheet is about all your history from the past, all the way coming to now, including this period and what's in at the end of that day. So balance sheet is a moment of time, but income statement is period of time. So now in balance sheet, because it is a moment of time, so it just cares about to know how wealthy you are, how you have your stuff. So for example, for this moment in time, I have a computer. The computer is $2,000. So this moment in time, my asset is $2,000. I borrowed $1,500 to buy this computer. So my liability is $1,500. And I also have $500 from my pocket. I have it. That's my equity. That money, I already have it. So I take that $500 equity plus $1,500 liability that equal to that computer I have. So the moment in time, I am only as wealthy as a computer owner. I have one computer, one and only, worth $2,000. So this is balance sheet. So now with my restaurant, remember I'm a restaurant owner for this example, and my asset is equivalent to all of these things. Look at it. I have cash on hand, so that's my cash in my petty cash box. That's my asset. I had a $30,000 PPP loan coming in at that time. Didn't spend it, didn't touch it, just coming in, okay? Then I EIDL loan bank for 150,000. Okay, that is my deposit in the bank from the EIDL loan. And I know you probably say, no, Ying, I only got 149,900. Let me just ignore that $100 and say that you got 150,000. Okay. You also have receivable, that's your asset. You have inventory, that's your asset. Then you also have fixed asset, which is 55,000. That gives me 252,400 as total asset. Out of the total asset, how did you come up with the total asset of 252,400? You came up with, you have account payable of 1,000 that you hadn't, it's a bill that you didn't pay yet. You have payroll liability of 1,000. It's the 941 you hasn't paid yet. And you have credit card 8,000. You have credit card balance you haven't paid yet. Okay. And all of these money already becoming those inventories that's sitting out there. So you got those ones. And you also have a liability because your PPP loan is a loan, right? It is forgivable, but it's not forgiven yet. You just got it, so that's a liability. So you are going to put that on here as a liability. And the EIDL loan, of course, is liability because that one is 30 years term with 3.75% interest rate. And you're going to have this amortization schedule come out of SBA. SBA going to tell you to pay for it. Okay, so that's why it's a liability right here. So we have a liability, and we also have equity because we have original $10,000 deposit. We also made $56,400 on net income. Remember, that was the net income we made for this period. So now when you end at the end of the period, and you put that in your equity because that's your money, you made it. All right. So this gives us the balance sheet when we just got the loan. So what is a journal entry? Remember, today it is more of accountant. Accountant will know what I'm talking about. And I want to tell you that when you receive your PPP loan, you're going to debit the bank for 30,000, and then you credit the bank for 30,000. And that's one entry, take care of your PPP. The other entry, you debit 150,000 for EIDL loan, you credit 150,000 for EIDL loan. And see, this debit and credit did not go to income statement. And I did not book the credit of 30,000 from PPP to income. Some people say, oh, wow, I am going to spend it really well, and I know I will be forgiven. I know I will make it as an income. Is that your income? No, it is not your income until you spent, until you are proved to be forgiven. So it will stay here as a liability. So that's our first step. What happens when you just receive your money? So you have journal entry to make, and you debit your bank, which means you increase your bank. Okay, increase your bank balance. And then you credit your liability, which means you increase your debt. Your liability just means things you need to pay back. Okay, so you increase bank, you increase liability. That's what happened to you right now when you just got the money. Now let's go back to what happened when I'm spending the money. That is the counting we need to look at. So now follow me on here. So assume June is the month, the June 1st is the date I received the money. And May 31st is the month we received the money. Then in the month of June, you spent it. Then what's going to happen to your June financial statement? Let's take a look. We assume our sales still goes the same. And remember, EIDL loan has a requirement. EIDL loan, you cannot buy equipment to expand your operation. You cannot buy a property to move, to relocate yourself. EIDL loan is for working capital. So someone asked me, Ying, what is the best working capital? And if I just gonna use something to for EIDL loan, I want to spend the money for something, what is the safest working capital I can use on? Cost of goods sold, your purchase for the restaurant materials, okay? So that's what I'm doing. So look, I used to spend $800 for cost of goods sold. I am assuming my operation is still exactly the same. So I actually would put in I use EIDL loan, $149,900 for purchase. Then I use $650,100 out of my sales. I use that for purchase. So I ended up used something from EIDL loan. Now let's go down. So what about my PPP? I used it up too. And know that the yellow one I have here, these are qualified PPP expenses. Qualified PPP expenses just means that $30,000 I have, I can spend on mortgage. I can also spend on utility, rent, and my salary. But there is another thing saying that 75% of all of your expenses must be for payroll. So if I have enough payroll to use for my PPP, I don't go anywhere. I just use it on payroll. See, that's what I did. I used to spend $100,000 on payroll for the same period. Now I'm spending $70,000 because I used another $30,000 for PPP amount. And see how I reduced my expense from $100,000 to $70,000. So that cost me, because I reduced it, the $30,000 was paid out of PPP, so I don't count them here. They don't belong to expense anymore because they are your loan, they are your forgivable loan, and you use that loan money to pay it. So my expense suddenly short for that $30,000. So I had a $30,000 more taxable income to pay taxes. If everything stayed the same, just reflected on that PPP, that means my PPP dollars will reduce my expense, in turn will increase my taxable income. Now let's look at this. See, I had two debiting here. This is one we are using. This is one we are using EIDL loan. EIDL loan is also loan, but EIDL loan can reverse the bank because we had the bank deposit. Folks, come here, take a look. This is my EIDL loan. I used it up. It was $150,000. I used it up. And my PPP loan, look, I used it up. But the way I used up the PPP and the EIDL loan, they look the same on my bank side. It is all money come out of bank. So we reduce the bank by $30,000, reduce the bank by $150,000. So they are zero. But we only have credit because credit $30,000 means you reduce bank by 30. Credit $150,000 in here means you reduce EIDL loan bank by that much. So what do we increase? If you have a credit, you must have a debit. In this case, that debit is expense. Why do I say that? Look, my $150,000 EIDL loan, didn't you already see that here? And look at here. And my bank charge was $100 before. Now it's $200 because there's a $100 EIDL loan was charging me for expenses. So my EIDL loan expense already in here, it did not increase my taxable income. It got deducted. Okay. And so you can see my blue color, I credited 150,000, then I debited 149,900 plus debit of 100. So my journal entry is perfect for EIDL loan. What about PPP? Okay, PPP also spent because you spent that on payroll. And this is what you should do. And you should reduce your PPP bank balance to 0 because you used it up. And you will reduce the liability to 0 as well. This means you got forgiven. When you finish your PPP expenses, and you will submit that for forgiveness. If it is all on payroll, if it is within the covered period, and you qualified for that easy filing because you didn't reduce your payroll, you didn't reduce salary and wages, then you are perfect. So you come in here, you reduce you used up your bank balance, and you reduce your liability because you don't owe. It is given by the government to you. And you might say that to me, well, Ying, I make this journal entry, so my PPP is gone. But what if the bank turns around and goes, oh no, you have $10,000 cannot be forgiven? What are you gonna do at that time? You will have another journal entry. So you will debit expense for 10,000, and you will credit your PPP loan for 10,000. So if you did not get through, and they told you that we're not gonna forgive you for a portion of the amount, that's what you're gonna put in. What happens when you do that? You reduce your taxable income because look at this. This 10,000 loan, that 10,000, when it will come into here, it will put back, it will not do 30,000 and it will only do 20,000. So our payroll expense will be 90,000 because 10,000 was not forgiven. 10,000 was not forgiven, so 80,000. Does that make sense? So you will bring that back into expense instead of not knowing and not even booking it back in. Because our PPP do not allow you to deduct that expense twice. So if forgiven, it is gone, okay? But it is not forgiven, we need to put it back. Where do we put it back? We put it back in the income statement where that expense belongs to. It has to be one of these categories, okay? So that is where we really want to give you that understanding of what you are doing with these two different government help to you. And look at here what I did. So on your PPP bank statement, you will see that on June 1st, you deposited 30,000. And then June 15, payroll 15,000. June 30, payroll 15,000. So your balance is 0. That is how you finish your PPP. But this 15 and 15 do not go to your income statement. They stay on balance sheet. They do not allow you to reduce that amount out of your income statement because income statement, this number is what IRS uses to calculate taxes. That is the number they want to know. So With this one, you cannot move that to be expense. With EIDL loan, it's different. EIDL loan, you have a deposit as well, and you have your bank fee 100, so that make your balance become 149,900, and we understand that. That is expense. And cost of goods sold, all these purchases, they are expenses because they are here. They are here. Okay, that $100 bank charge is here. See how they got calculated into the body of income statement? So you only get small taxable income. Otherwise, imagine if they don't come here, you will have a bigger balance, right? So this is where we want to hone you to home, so you know that exactly what the difference between PPP and the EIDL loan. I know it's a little bit accounting, a little bit debit credit, but I'm so hoping that I have the talent to make complex matter rather see-through, so you can kind of tell what I am doing. And in this particular balance sheet, you can tell that we actually have, at the end of it, we used up PPP, and we still have the loan to pay. And in here, the banks are gone because we used them up. And I hope this gives you some good guidance. If you have questions, send it to me. If you like my spreadsheet, ask, I email to you, and hopefully this is helpful to you. And don't forget, go to YouTube, Community CPA channel, subscribe to our channel, like us, share us, and that's a golden rule. And I will see you again. Bye-bye.